morning, good evening, wherever you may be watching this video. Today, I want to discuss playing defense in the DeFi landscape. There's been a lot of liquidations across the market, a lot of people essentially losing all of their hard earned assets by essentially making some really irresponsible decisions. Despite the market downturn, you can still earn a pretty decent yield on your assets without risking it all. And in today's video, we're going to discuss the different strategies that you can apply to how you approach the DeFi markets and make sure that you are not over leveraging yourself or opening yourself up to unnecessary risk. So, with that being said, let's get right into today's video. All right. So, first things first is it really depends on how you actually approach DeFi. So, it's not really a secret that I approach DeFi by first borrowing against the assets that I have available. So I may put my assets on a platform like Kinetic and borrow a percentage against those assets. Now, the key here is to ensure that you maintain a solid health factor. So during bullish times, I think that maintaining a 2.0 health factor or more, 2.0 being the minimum, is where you should be. Now, a health factor of two essentially just means that the available assets that you have set as collateral is two times the amount in which you've borrowed. So if the asset collateral begins to dip down, you will be okay until you reach about a health factor of one, where you're essentially just 1 to 1 in terms of collateralization and you'll be liquidated. Now, during times like these where it's very volatile, we seemingly have hit the early stage of a bear market, at least for the time being. Who knows? Anything can change. I don't think a health factor of two is sufficient. I think if you can maintain a health factor of anywhere from 3 to 5 or more, that is really where you want to be just in case anything happens. Now, why does my mindset change depending on the conditions on the market? Well, it's just that you really don't know what could happen. Asset prices could dip even further, and you don't want to be caught wrong footed. How do you maintain a health factor of that magnitude? Well, you don't really borrow as much. And even if you do borrow, your main focus isn't just profit taking, it's really to ensure that you're able to pay that loan down as quickly as possible and as frequently as possible. Because on platforms like Kinetic, you do have to worry about interest depending on what you are borrowing at the time. So if the interest is quite high on the assets that you decide to take leverage out against your collateral, you'll be paying a lot more. You definitely want to make sure that you are focused mainly on splitting your profits between not just profit taking, but also paying down that loan to just keep yourself in a healthy position just in case anything were to happen. After I've borrowed against my assets a healthy amount, I'm not going super degen. You can be a degen, but degen responsibly. I normally start looking at LPs that I want to enter, or I've already scoped them out and I know exactly which ones I want to enter before I even borrow against my capital. And the way that I approach looking at what LPs I think are worth me getting in, whether it's the APRs or any of my other criteria like volume, 24-hour volume, fees that have been generated in that pool, and several other factors, I look at the correlation of those assets. The reason why the correlation of assets that you pair, especially in LPs, matters is because when one asset is experiencing a downward turn, you'll increase your position size on the other asset that you are pairing against. So it's very important that you choose assets, especially during times like this. You choose assets that are closely correlated with each other. Because what does that mean? That means that when an asset closely correlates with one another, that they typically move together in the same direction. If you choose assets that are not necessarily correlated tightly, then they can move in opposite direction of one another. So this is really important to pay attention to during times like these, so you're not hit as hard in the LP in terms of losing value. Of course, if the whole market is going down, then you're going to experience some downward turn. But it at least will not put you in a position to where you're accumulating one asset that you just don't necessarily want to hold long term over the other, which is another key factor when looking at LPs. Make sure the assets that you're pairing against each other are assets that you would not mind holding long term if you got fully converted into one or the other. To see whether assets are closely correlated or not, I use DeFi Llama. They have a correlation matrix that is extremely helpful in determining how closely correlated assets are and helps me in my decision making on whether or not pairing these assets together fits in my risk appetite or my risk profile. The closer assets are to one, the closer they are to being really correlated. So, or the higher the correlation is. So, you always want to look for that. The further away those assets are from one, that means that they're not so correlated. So, keep that in mind. Keep that in mind when looking at assets to pair against each other and entering LPs. Another topic on the LP side of things is rewards. When you go to claim your rewards, again, it's not just about profit taking. During times like this, you almost want to put more towards paying that loan down than you would putting in your pocket. So, yes, you are still earning something in terms of putting your assets to work, but your main focus is making sure you are able to pay that loan down or pay yourself back essentially as quickly as possible, so you're not having to carry that debt for a longer period of time. The closer you are to having that paid off, the closer you are to basically playing with house money. And nothing is ever wrong with playing with house money. That's actually the best position that you want to be in. Once you've gotten to that position, then by all means take as much profit as you like. Until then, while maximizing the potential of your capital and the overall usage of that capital, you want to make sure that that loan is the top priority in terms of getting paid down while taking a little bit off the top for yourself. Not so much should go into your pocket until that loan is paid off. Once that's paid off, you're good to go. Another good strategy when playing defense in DeFi, especially when assets are experiencing a downturn and are losing value in terms of price, uh, your long-term bag is going to experience some downward pressure in that sense. You're going to see your long-term portfolio decrease in value from that perspective, but you don't necessarily want to sell at a loss. So what you could do to play some solid defense is to enter shorts against those very assets that you're holding long term to help accumulate some type of value, whether you utilize the earnings from the successful short positions for playing down the loan that we talked about in the beginning of this video, or to help accumulate more of that asset without necessarily having to take out more capital from your pocket to buy those assets. These perps platforms are very powerful and very useful tool in those cases. So FlameX is a perps platform that you can trade on. SparkDex Eternal is another platform that you can trade on. On FlameX, you can open up trading positions against BTC, ETH, BNB, Sol, XRP, Flare. BTC and ETH are the two assets that they're offering up to 500x leverage on. SparkDex Eternal has a bit more assets to choose from that you can trade against. Obviously, Bitcoin, Ethereum, XRP are available, but you have a much longer list here of assets that you can enter positions on. Now, I do know SparkDex offers up to 100x leverage on tradable assets. and that leverage may vary depending on liquidity available for that asset, but nonetheless, leverage is available. Now, the perps platforms are definitely useful in terms of hedging against your long-term bags during these downward times. Like I said, you can accumulate more of that asset, or you can utilize the profits that you earn from successful trades to help pay the loan down even quicker, which is something that I would definitely suggest. Again, once you've achieved paying that loan down, if you actually end up taking any leverage, then you're playing with house money. You can take as much profit as you want, or you can decide not to take any leverage at all, right? And still utilize some of these strategies that we discussed in this video. Leverage is not the bad thing. I want to make that clear. It's how leverage is used. If you overdo it on the leverage side and you take out more than what you can actually pay for, then yeah, you're being irresponsible and bad things can for sure happen, especially in times like these. But if you use leverage responsibly and you have clear strategies that you stick to pay that loan down in a solid amount of time, then you really have nothing to worry about. If you can maintain the health factor, if you can monitor your positions, if you're just overall sticking to your strategy of paying the loan down, taking some profit off the top, but not too much, mainly focusing on paying the loan down, not taking too much leverage, hedging your positions via these perps platforms, you will be all right in DeFi. It's only when you overdo it and you don't stick to the plan or not have a plan at all is when you get yourself into trouble. These stories that you're seeing of people getting completely liquidated, if you really just read the fine print, essentially, they tell you that they were being irresponsible. I just read a situation yesterday about a guy that made $10 million in the crypto markets and essentially full ported that 10 million with a 3x leverage and lost it all on a long position, because obviously the markets are going the complete opposite way. Everything is experiencing some type of downturn, and that was completely irresponsible. Why would you not take any profit after making $10 million? I don't know. Why would you full port $10 million on 3x leverage, especially with the long? That to me is just greed. There's no other explanation of that. So if you can keep yourself level headed, keep yourself grounded, don't get greedy, take what you can, and don't overdo it, I think you'll be fine. Right now, a lot of people are scared of DeFi because of all these different stories that are coming out. But ultimately, you can boil down the crux of the issue in a lot of these scenarios or a lot of these situations by that person being irresponsible and greedy. If you can steer clear of that, you'll be all right. So, with that being said, I hope you guys enjoyed this video. I hope you guys found this informative. Please like, share, and subscribe, and I'll catch you in the next one. Peace.